Hello, everybody. Brian here from quantlabsnet.com. In this video, last, I don't know, 4 or 5 videos, small number of views, but these are videos I'm putting out on the importance of institutional level trading done by, yes, high frequency trading uh, firms. These are the skills you'll need to pick up when it comes to software development or engineering, along with the quant relative size side of things. So all these videos are important to watch. And now I've just did a hedging video. Now we're going to do a arbitrage video on what this reporting, call it whatever you want, will do. So I've already explained why I do everything in Python. I'm not going to do that, but or explain that again here. So here in the arbitrage examples, I'm going to show you what we're doing here. So with arbitrage, you can do a variety of combinations here depending upon what the market tells you. You can buy a futures contract, you can overlay it with a bunch of options uh, as well. And that's to maximize your profit, but also protect your downside. I've already kind of explained that in the hedging video. So let's go through this example. So here we have a soya market example, cash price at 505 per bushel. We have a November futures price at 533, and then we project out beyond March at 574 per bushel. So when it says here unusually high, it can be off. So the farther out you go, uh, the less predictable it is, I guess. You only know that working with it and actually analyzing the data to really understand the pattern of the futures market and whatever commodity you trade. But again, the markets tell you where professional, institutional level traders are trading. And also, even when it comes to the Fed buying gold, and this is very important data. And this is where the institutionals will project. And this is why futures and options is really, really important, critical to your success in trading and building a career out of it, and really uh, uh, building out wealth from it. Because when it comes to, as I said before, crypto trading, forex trading, stock trading from a retail point of view, you're just chasing returns. It's different if you're investing in ETFs and stocks, like long term. That's not trading. That is not chasing return. But more of the high active traders are just chasing returns, so they give profit, and then the markets will take back a lot of the profit, because a lot of these people just don't really understand how the markets work, and a lot of the activity is going to be done in the futures and options. So arbitrage is one of them. So here, as part of the arbitrage strategy, what we could do here is we can buy a November future, take delivery in November, and obviously most future traders will not take delivery. I can mention about gold, different story. Store the soybean and sell the March future. So this could be a farmer, corporate farmer, for all we know. Another great example, real world right now with everything going the way it is in the market. Again, March 15th here, 2025. Many operators out there when it comes to gold are not taking paper and rolling over future contracts for gold anymore. They're actually taking physical delivery, and that means it's a standing order. And usually in the London markets where a lot of gold is traded, it's usually a 3-day settlement. Now it's up to, I believe, up to 8 weeks of settlement. So that's what's going on in the general economy right now. Something is scary is coming down the line. Again, March 15th, 2025. So that's how important the markets are. And a lot of the federal central banks will be buying up gold. So like everybody does this from an institutional level. Enough diatribe here. So let's go back to our basic example. So we have these combination arbitrage strategies, or do it as one complete strategy. So in our case, based upon what we have here potential profit. So if we have a March future contract 574 minus the 533. That gives us 20 cents, and it's 21 cents per bushel. So basically, the arbitrage activity narrows the price spread between November and March futures, bringing in line with storage costs. Okay, so again, that's more the commodity producers, in this case, soybean. Um, and that's why people like gold, because it doesn't really have all these extra um, uh, counterparty risk. Anyway, I just want to mention that as well. Okay, so let's check out a combination of this one, arbitrage and hedging as well. So let's see what that does. All right. So again, as I said before, if you're new to this, doesn't matter what it is. The mechanics are the same. What we're looking at is the data, the type of parameters involved, and the results. That's what we're after here. So it doesn't matter what commodity it is. As I said, what matters is the input, the result of the parameters, and the data and what comes out. So in this case, we have uh, whatever it is per bushel, 463, initial uh, future price at 465. So here, when you say cash price, that's the spot market, today's cash market price. The futures price at 465, or whatever future contract you're looking at. So we have a cash outlay for 1,000 bushels is going to be 463,000. Again, this could be a commodity producer. So our total revenue from selling the futures, and there's the math behind it, could be 2,325,000. Again, this is all in development as well, so this could be off. So the profit is when the prices converge at 525, and then that would be 180, 100 million, 1.84 million, let's say. So that's just another involving hedging on the arbitrage to analyze that. As I said before in the hedging video, a lot of firms do this and simulate a lot of this. Okay, so here, if we have a static profit loss from where the futures market is left unchanged, uh, if the profit rises to 650, here's our profit. When the profit loss when the future price falls to 550, what will that cost? So that's the whole point of this, to be able to simulate before you put on your positions to reduce your risk and hopefully maximize your profit. And a lot of this is just using simple math. A lot of the places you go will not teach you. And again, this is only for futures options, not equity, not stock option. Okay. So again, here, another example, if we have an expiration, what's our P&L? Profit and loss at zero. If we do a short call, it could be 20 cents. Long put at 15 cents. So our net loss would be 5 cents. So essentially, you could ask yourself, what's better, to do a long call or a long put? So again, there's all those tools available out there to analyze that and simulate that. That's the important part of this, to be able to calculate this, that a lot of the institutional level traders, before they put on positions and build a strategy using arbitrage. So what you're seeing here is what the professionals will do. So let me just see. Okay, let's run another scenario. This one. Okay. So I believe, yeah, okay, let's see if this works. Okay, I think we just ran that. I'll run this one, the third one. Okay, same thing. All right, so let's run a arbitrage scenario sample. Okay, people might go, well, this is useless. Okay, if you don't see it that way, that's fine. Good luck in your trading. So here we have a hypothetical arbitrage scenario. Again, it's all about running simulations and what we should do. With the hedging, we're looking for an optimal hedging ratio to work with. Here, we're looking at, if we have, in this case, call premium versus a put premium at 21 cents, and then the future price versus the strike price. Is there an arbitrage opportunity here? So you can calculate these metrics parameters to say, is there an arbitrage opportunity? That is helpful right there. All right, so we'll do one more strategy. Okay, so strategy is to find where you have looked at the markets with what I'm doing with the simulations and the forward looking data and the results of that. And we go, okay, this looks good. Let's build a strategy around it. Okay. So in this case, we are going to run one. Let's see what it says. Okay. Oh, typos. CHG Python. Oh, let me just do this. Okay. Alrighty. Boom. So here we go. I think we've run this before. If we have a future price unchanged, again, I think we've run this short call profit loss, long put call, and then we measure the net. You know, this is simplistic stuff, okay, to show you. Anyways, that's what I got to show you here. So in here, on my website, if you like these sort of things, go to quantlabsnet.com and get yourself in the Learn tab. And then there you'll see get yourself a C++ HFT. I'm doing things that are HFT like, okay, trading, quant, and the actual programming itself. And in your info here, we don't release it to anybody, but we do send out things from the blog. And that can be multiple times a day, it could be daily. Here's our blog. So these are the topics we're talking about here. Arbitrage, as I showed you, call put parity, um, efficiency risk frontier, blah, blah, blah. And there is a technical side as well. All right, we'll leave it at that. Thanks for watching.